Hello and welcome to another edition of Client for Life. Today I'd like to introduce Noel May from Noel May Associates. Noel's come in to have a bit of a chat with you about the importance of choosing the right tax accountant for your property portfolio. As Noel says himself, if you want general advice, you go to a general practitioner. If you want a specialist opinion, you go to a specialist. So, Noel, what's the most important thing that my client should look for when choosing an accountant to do their property portfolio?
It's important to work with someone who understands that whole area of property. Most accountants know a little bit about it, but the property decision for you is a major decision.
Absolutely.
And it's part of your investment, it's part of your future, and you don't want it to be brought undone by some poor or ill-conceived or it's tax advice that's not totally honed in to what you're doing.
Because my clients, we go to so much trouble to choose a good property in a good location. We look at amenity and transport, and we really try to capture a good tenant that'll pay the most of the mortgage. And the way we put the formula together was to really avail ourselves all the deductions that are currently available today under the ATO rulings.
Sure. Yeah. And it's important when you've gone to that much trouble to make sure, for instance, that it's in the right structure, that it's held the right way by the right people. And you need to put a lot of thought into that up front before you actually get going, because if it's not, it'll cost you money and it's extremely expensive to unravel. So
it's actually one of the things we spend a lot of time doing is getting the structure right. And obviously, if you've got investing in couples, one might be the dominant income earner, and I see lately too, particularly clients that have been 4, 5 and 6 years in the program, if wage ratios change, it's good to have a bit of foresight and insight into what the future may hold there.
Absolutely. A structure that suited you 5 years ago may not suit you now, because people may have changed their jobs, they may have changed their roles. They may have children that are now of mature age. And so each property purchase needs to be re-examined again as to see which structure is appropriate, and you may very well change.
So it's not just a matter of doing your tax return every year, it's a matter of sort of sitting down and having a discussion and really having a consultation at the point of return, because one of my big frustrations is that we do the property investment analysis here. We take into consideration everything from interest rate to water rates to depreciation schedules, and I'll hand the PIA to the clients, email it, but it seems to get lost in translation when it gets to the accountant's desk.
Yeah, look, it's very easy sometimes to overlook all of those things unless you're working with it every day and you're attuned to what you can and you can't claim. It's very easy to miss a claim, and it's quite right that you can claim as much as you can. The tax law says that you're allowed to do that.
That's right.
And so you need someone who's really keeping an eye out for all of those different deductions and what you can and what you can't claim. On the other side, you need to be careful not to claim things you're not allowed to claim.
Of course, you don't want to end up on the front page of the Herald Sun.
And there's a lot of myth about, oh yes, I can claim that, I can claim that. And you don't want to be in the bad books with the tax office.
For sure.
So you should claim what you're totally allowed to claim, but don't cross the line.
Yes, that's right. That's right. I have clients coming in still that have perhaps opted for lender's mortgage insurance and been told by their accountant, oh no, you have to capitalise that, when in fact you can write that off over 5 years.
Yeah, sure. I mean, those are the sort of things
right.
that you can get advice that's not quite right, and you don't end up with getting the maximum refund, which is what you're really
Well, that made
after.
$2,000 a year difference to her over 5 years. That was quite an oversight, really, wasn't it? So Noel, given that it's tax time, you've got some fabulous forms, and we might actually create a link so that you can actually press a link to download those forms. But just tell us a little bit about the process from here.
Okay, well, the forms are just an easy guide to help people, your customers and clients, if they want to use them. What it often does is trigger things in people's minds, and they go, oh, look, there's a line there for this. I didn't think I could claim that, and that might create a question.
Great.
And make sure you can use the forms just to make sure you're getting the maximum out of what's available to you. So it's a little, you know, this
Bit of
is
a
your
teaser,
income,
a reminder.
this
Yes.
is your expenses, but mainly
Yes.
all the sorts of expenses
Yes.
that you're allowed to claim.
Okay,
Yeah.
fantastic. Well, we'll provide those links for you. You've met Noel now. Any questions? We'll also put his email address for you. Don't hesitate to contact him. He's got a brilliant team. Remember, the formula is what makes stress-free investing, and a big part of the formula is getting the tax returns right. So, look, thank you all so much for joining us again. See you next week, and thanks again, Noel. Really appreciate you taking the time.
It's a pleasure.
Thank you.